The four most dangerous words in investing are, this time it's different. Sir John Templeton. Right now, the market is whispering those words, not screaming, whispering. And that's what makes it dangerous. Because the market today feels like a guy at 3 a.m. saying, "Relax, bro, I'm totally fine," while holding a flaming trash can. We've seen this movie before. Actually, we've seen the trilogy. In 1972, there was something called the Nifty 50. 50 can't-lose stocks. Coca-Cola, IBM, Xerox. People paid 40x, 50x earnings because they're quality. Then the 1973-74 crash hit. The S&P 500 dropped 48%. Some of those can't-lose stocks fell 60 to 70%. Fast forward, the dot-com bubble. Cisco trading at 130x earnings. People saying, it's the internet, valuation doesn't matter. Then boom, the NASDAQ fell 78%. Now here we are again. Different decade, different technology, same human brain. Let's talk numbers. Right now, the S&P 500 trades around 22x forward earnings. Not insane, but here's the twist. The Magnificent Seven, Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, Tesla, they account for roughly 30 to 35% of the entire S&P 500's market cap. 7 stocks out of 500. That's concentration we haven't seen since the dot-com peak. Now look at Nvidia, at one point trading above 40x forward earnings, after a run of more than 200% in a single year. Incredible company, but price and value are not the same thing. Here's where it gets quieter. Corporate debt in the US sits above $12 trillion. Government debt, over $34 trillion. And interest rates? From near zero in 2021 to over 5% on short-term treasuries. Translation, the era of money printer go burr is over. Liquidity isn't flooding the system anymore. It's draining, slowly, silently, like a bathtub with a tiny crack, and nobody notices until the floor caves in. So what's the silent crisis? It's not AI, it's not stocks, it's fragility. When gains are driven by a handful of giants, when passive investing automatically buys whatever is already big, when retail investors pile into the same trades through ETFs, you get a top-heavy market. If those 7 stocks sneeze, the index catches pneumonia. And here's the uncomfortable part. Most people think they're diversified. They own an S&P 500 ETF, but 30% of their money rides on 7 companies. That's like saying you have a balanced diet because you eat pizza with different toppings. Still pizza. Now add higher rates, refinancing risk, slowing earnings growth, and geopolitical tension. You don't need a crash. You just need a catalyst. Something small, something boring, that tips the first domino. And markets don't collapse because everyone is scared. They collapse because everyone was comfortable. Now, let's slow down. This is not a doom prophecy. The US economy is still growing. Unemployment is low. Corporate profits are strong. Innovation is real. AI is real. Productivity gains could be massive. But history tells us something simple. When valuations stretch, when concentration rises, when liquidity tightens, volatility follows. Maybe not tomorrow, maybe not next year, but cycles don't get canceled. They just get delayed. So what do? You don't panic. You don't go all in either. You manage risk. You question narratives. You remember that markets move in cycles, not straight lines. Because the loud crashes make headlines, but the silent crises, those are the ones that build slowly, right before 2027 knocks on the door. This time might feel different, but human behavior never is.